Okay, Meir, we're going to get started here. I think Shlomo's all set, and so am I. So we'll get going here on the seminar.
Okay.
So
go ahead.
Good afternoon, traders. Welcome. Decent morning session this morning. Came back from a red start, and now just poked over the green for the morning. And today looks like we've got Meir 142 in the room, so that's great. Very good. And as Shlomo's slide points out, we've got bull market we'll be talking about today, the loved and hated stocks, and then really capping off last week and transitioning into this week, and then looking at the Alibaba trade. We're going to be looking at the what to do after the iPhone 6 comes out, which the announcement is tomorrow, pending on September the 9th. So we're looking forward to that. And moving on from there. So Shlomo's going to talk a little bit about that after I'm done here, just with the introductions. So, okay, Shlomo, if you want to turn the slide to the next one, and we'll go ahead and get started. For many of the traders here that have been with us for a while, this slide you've seen before, but as we bring in new traders, it's worthwhile to talk a little bit about the things that go on in the trading room and our proprietary trading team. So let me go through some of the bullets that you see up here. First on the left, we'll start with the trading room. You know, why TradeNet and why this trading room? I've received so many emails about, you know, how great the trading room is, and we really enjoy your commentary and Meir and the training through Shlomo and all of the analysts here. And that's because we do it in real time. You see the real-time charts. This has led the team of traders here, are real traders, both Meir and I, Shlomo, trading in real time in the trading room here. The key features that I did want to expand on is the real-time audio. Many of the trading rooms that are out there that are not with TradeNet, they'll be posting and typing in their trades, and if they trade them or not, you don't really know because they're just typing them in, and it can be seconds later, it can be 30 seconds later, 15 seconds later than what they actually take, just because of the typing. And with TradeNet and with our trading room here, we are on real-time audio. So you hear us, you physically see the chart. We explain the entry, we explain the exit, we talk about the stop loss, we tell you why why we're taking the trade and why we're getting out. And that goes hand in hand with the live charting. Also, the presentations, as you're seeing today, led by Shlomo, these are things that we bring to you multiple times per month. And we talk about them and go over some of the key interests that you guys have. A lot of these presentations are from some of the things that you've said in the room. You'd like to see this from Shlomo, or you'd like to review that. We take those into consideration as we formulate the webinars going forward. So, you know, to kind of finish things up about the trading room, it's real-time trading from real-time traders. We pride ourselves on transparency about when we take the trade, how we take the trade, and what develops from that. We're not too shy of talking about our losses along with our wins, so it's very, very important that we keep the transparency at the highest level, which is important to not only ourselves, but you, all the traders in the room. Also on the right side of the screen now, I have the proprietary trading team, and I just want to talk for a few minutes about that and what the prop team is. The proprietary trading team is really a trading education package, and with that package comes a self-study training piece to it that you can go online and learn about how to trade, learn about what to do to get started. We also have the live trading room, which you're witnessing right now. Here in the live trading room, we talk about stocks, we talk about the entries and exits like we just talked about here just moments ago. And then with one of the packages, the higher level package, we also offer the Top Trader course, and the Top Trader course takes it a step even further. And those are for some of our expert traders that we take them to the next level. And it's just a great atmosphere to transition into and to develop your trading skills as a proprietary day trader. We also offer demo to live trading, and this is really important. We've talked this through many times, and what's key is for you to get into the Colmex platform, Colmex Pro platform, in a demo experience. So you demo in real time charts, real-time trades, with demo account. And that means you're not live, but it's the next best thing, and it allows you to get really entrenched into the platform, to see how it works, to see how it benefits your skills and the speed of the platform. Next, we also offer increased buying power when you become part of the proprietary trading team. So you'll have great tools with the trading platform, with the training, and then that increased buying power for you to take advantage of the market when you're trading each and every day. We have a monthly profit pay, and that works out as 100% payout. So if you come in, as I've noted here, with the two levels of a $10,000 and $25,000 level, up to that $10,000 of your first profit, we pay you back 100%. So every dollar that you earn, you're making back that dollar, and we pay out on a monthly basis to our prop trading team. And now we've developed through Meir and the rest of the team here, we're going to be having some mentoring that's going to be kicking off here in the next. We're going to be coming out with a brand new website that's going to be introducing the mentoring program, that you can really take advantage of having a mentoring class that's led by myself, by Shlomo, by Meir, and it really takes that holding hand approach to the next level so that we can meet the needs of individual traders, help you with your daily trading experience, and to make sure that you feel very comfortable with what you're doing with the platform, and then to answer all of the questions that you may not be able to, that we may not be able to get to on a one-on-one basis here in the trading room. So that's coming out. We are continually evolving as a trading team with TradeNet, and the proprietary trading team is really taking off to where we're providing a great training for our students, a great educational package, and they're able to take advantage of that with one of the best platforms in the marketplace to become a great trader. So again, I've got my email address up there. You guys feel free to email me at any time. You can private message me here in the room. I'll answer any questions during or after the presentation today, or throughout the week. Whenever you have something, just go ahead and shoot me an email, and I'll try to get to you as best I can. So really appreciate the opportunity. And Shlomo, I'm going to hand it back over to yourself so that we can learn more about what's coming up with the iPhone announcement tomorrow. Thanks, guys.
All right, many thanks, Scott, for the introduction. Great to be here with you, and just to say a couple of things about this great trading room. I think that one of our missions going forward with this trading room is actually to equip you with the best tools to really go forward in the environment of trading, and to be equipped with best information and with the best top cut of the edge information in order to win day in and day out in Wall Street. So today, after the webinar we had on Thursday regarding Alibaba IPO, and part of you already took advantage of this webinar and jumped on Yahoo. And actually, you know, we talked on Yahoo on Thursday. It ended the session of Thursday at 39, and it popped up really nicely for the last 2 days. So we are already 5% in the money, but as you already know, I think there are much more to look forward from Yahoo. All right, today we are going to talk about the Bull 2K. We are going to take an historical look on the great runs of the S&P 500 since the start of this index back at 1928, and we are going to draw some conclusions from these all great bull runs, and also we are going to understand how this current bull run that is already with us more than 5.5 years, how it looks in the big frame, in the big picture, in the historical picture. After that, the 2,000 points mark that the S&P 500 conquered last week is a great place. It's a great time to see what the analysts in Wall Street think right now on stocks, on individual stocks. Is the stock market too much, too high? Is it too expensive, or or is there more room for the stock exchange to go on. And by the way, just to share with you that I saw a report coming out from Morgan Stanley last week, and they actually are predicting that the S&P 500 is going to climb from around 2,000 points right now to around 3,000 points within the next 6 years. So actually there are big institutional firms in Wall Street that think that there is much more room for the S&P to go on, and I'm on their side, as you are going to see. And of course the main subject, the main issue we want to deal with today, and we all the time want to give you current information, something that is interesting all the Wall Street traders. And it's of course Apple. Apple is going to make a big announcement tomorrow. Of course, all the rumors are saying that it's going to use this big announcement to launch the new series of the iPhone 6, and maybe to also present a new device, a new wearable device, or probably it's going to be called the iWatch. And I want to tell you what I think we should buy after Apple is going to launch these products. And there are a couple of very interesting investments and trades we can use this event to make for our portfolios. So let's start on. And 2 weeks ago, the bull market celebrated the S&P 500's break above 2,000 mark for the first time ever. As an anchor to that feat, last week they celebrated the bull market's 2,000-day milestone. As most of you are already well aware, a bull market is defined as a rally of at least 20% that was preceded by a drop of at least 20%, and a bear market is a decline of at least 20% that was preceded by a rally of at least 20%. The table right now that you can see on your screen is showing us the historical bull markets for the S&P 500 dating back to 1928, and I sorted this table. This is actually an Excel table. I sorted it by length in days, in terms of days. So the current bull market, and I highlighted it in a yellow marker, the current bull market now ranks 4th in terms of length, as you can see, 2,005 days, but also it ranks 4th in terms of strength, and actually it's almost made 200% from the bottom back in March. It needs to last another 244 days to pass the third longest bull market that ran from the 3rd of October 1974 till the 28th of November 1980, and it actually needs to last another 600 days to move into second place. First place is even further out of the horizon right now, and actually the best bull market we had was from December 1987 till March 2000. It was the greatest 30 years in history, when the market climbed and climbed and climbed. It actually delivered an astonishing yield of almost 600% in almost 4,500 days. By the way, we can see here at the bottom of the table, we can see here that the average bull market for the S&P 500 lasts 933 days, and it sees a rally of more than 105%. So at 2,005 days with more than 190 6%. The current bull market is just about double the average, both in terms of gains and length. But you know, there is much more room for the market to go on, to climb on, and there is still chance that it's not going to end at a fourth grade, but it's going to climb to the third rank, or maybe to the second rank, and that means we can go much further. By the way, if you can spot the third rank and the fourth rank, pay attention that in terms of strength, the current bull market, although it's shortened than the third rank, it's stronger than that. The last bull run climbed 125%, whereas our is currently 196% up. Next slide, we have updated our historical chart of bull and bear markets for the S&P 500. The green shading represent actually the bull markets, while the red shading, and you can see that it's much more narrow, the red shading represents bear markets. And so as you can see, bull markets in general last much longer than a bear market in terms of time. And on the black line, you can see the movement, the price action of the S&P 500 through this period. And by the way, you know, so if the bull runs are much longer in times, that means that currently it's a great environment not only to be a trader, a day trader, a short-term trader, but also to allocate some of your money to the long run, to long investments, and this is a great environment to make honest gains to our portfolios. And more than that, although the red shadings, which represents the bear market, are much narrower, that means that when the collapse comes, when we see blood rivers crossing Wall Street, that means the collapse is much harder, is much faster than the bull market. That means actually that we as short-term traders really like bear markets, because literally your money, your profits are coming much more faster, and they are much more big than in a bull run. Let's move on, and here on the chart, the second chart shows the length of bull and bear markets in order since 1928. And this chart really shows how the typical bull-bear market cycle has lengthened over time, and this is something really interesting. Early on for the S&P, when I'm going back on this slide to the zone of 1928, this was the year when the S&P 500 actually was established. It was early on for the S&P, when the US was still a developing country. Bull and bear markets occurred much more frequently, much more rapidly. So as you can see, we had lots of cycles, but each cycle was much shorter in time. As the economy of the US, and therefore the market, has developed and matured, the bull-bear market volatility has decreased. Much in the same way, a low market cap growth stock grows into a big blue chip. So today, the cycles are much longer in terms of times, and on the Y scale, by the way, you can see the length in days. So as you can see, this is the best bull run we had in history from 1987 till 2000, but right now this is the bar of the current bull market, and it looks distant, and it looks really nice. While the bulls may have reasons to celebrate. They certainly didn't show it in the stock market last weekend. Let's go to talk a little bit about the market, about the last couple of days on the daily and the weekly chart. On the right side, you can see the weekly chart of the SPY, the ETF that tracks the S&P 500, and on the left side, you can see the SPY, the ETF that tracks the S&P 500, but on a daily chart, each bar represents 1 day of price action. And in what was a holiday shortened week last week, the S&P 500 traded down for the first 3 days of the week, and as you can see, we had here 3 red bars, one after one, and it looked like we were in store for a 4th straight down day early on, but by midday Friday, and let's just move on to a 5 minutes chart, and I'll just stay here with the daily chart, and I'll go on the right chart to 5 minutes chart, and let's go to Friday action. Right, and I'll just squeeze this chart so we'll see everything in one picture. All right, so this is the action on 5 minutes chart of the S&P 500 of the SPY on Friday, and it really seemed that we are going to move to a fourth red day, but actually on Friday, but in midday Friday, equities finally were able to master a push back into a positive territory, and believe it or not, if the S&P 500 did finish down Friday, it would have been the 4th straight down day for the index, and this is something we haven't seen at all yet this year. It is actually, and we say it all the time here in the room, that in the stock market, bad news is good news and good news is bad. And looking at the last 5 weeks, and here on the slide we can see an intraday action since the 1st of August. We can see here that we have seen a textbook example of that theory. During the weekend, I want to tell you, I did what I'm doing each month, and that was to review the market headlines for the previous month. So in the last weekend, I reviewed market headlines for August, and when I reviewed the headlines, what I saw was the worst month on a geopolitical basis in recent memory. A European economy that is falling off a cliff, and no substantive action from ECB head Mario Draghi when he spoke 2 weeks ago at Jackson Hole. How did the market react to that? How about 3.7% rally for the S&P for its best August since 2000? Now this month, and this month is shaded by a gray shade. This month, even though it is only a few days in, we have seen an improvement in the geopolitical picture with the ceasefire in Ukraine and Russia, accelerating growth in the US economy. Both ISM manufacturing and the non-ISM manufacturing reports were stronger than expected last Thursday, and even Mario Draghi came through when he announced a stimulus program worth almost $1 trillion. And actually, this is something to another discussion, what means the $1 trillion stimulation program and how that's going to affect the stock exchange in Europe and the stock exchange in Wall Street. Just to remind you that when Ben Bernanke pressed on the button of the QE back in 2008, we've just seen right now together what it made to the one of the best bull markets in history. But this is something to another discussion. Events like these would usually push stocks higher, not lower. And ironically enough, the one day we finished up last week, and this is represented by the last red line here on the chart, was actually Friday, when the non-farm payrolls report missed consensus forecast by the widest margin since January. Actually, the job market in the US created only 142,000 jobs versus to the expectations of the economists, which were set at 230,000 jobs. So the mark of 2000, and by the way, if one of you or anyone wanted to have these slides in front of his eyes, if you want me to email it, don't hesitate to ask me. Don't hesitate to send me an email, and you have my email on all of these slides. So just send me an email to shlomo@train.co.uk, and I'll send you this presentation to your email. And on the following slides, we are going to take a look right now when we celebrated the mark of 2000 on the S&P 500. We are going to take a look on analyst ratings for S&P 500 stocks, because it's really, really interesting for us as traders as well as investors to understand what are the analysts, how the analysts look, what is their view on the S&P 500 and on individual stocks. Are they still love stocks? Are they still recommending to buy stocks? Maybe they are all pushing on sell recommendations to their clients. So this is something we need to discuss. So first of all, here on the slide, and be here with me, in the S&P 500 alone, there are more than 12,000 analyst ratings, and we can see here the total. This is the total recommendations of analysts on stocks, more than 12,000 ratings, or an average of 24 ratings per stock. Overall, more than 50% of all ratings are buy ratings. 43.7% of all the analyst ratings are hold ratings, and 6.2% are sell ratings. Before going crazy thinking analysts are only bullish due to the low percentage of sell ratings, keep in mind that these percentages are roughly in line with where they have always been. In general, it's rare for analysts to slap a sell rating on a stock, because they are getting paid for recommending to buy a stock, not to recommend to sell a stock. And a lot of time, if an analyst think you should sell a stock, why for him to bother to cover the stock? Why for him to bother to spend time making on the analysis? Because he want to go on to Wall Street with a report of a buying rating, not a selling rating. Now, since the start of the year, we have actually seen the percentage of total buy ratings drop 0.52% since the start of the year, down to 50.1%. We've also seen a small drop in sell ratings from 6.32% to 6.2%. So with buy and sell ratings dipping this year, we've seen hold rating increase actually from increasing by 0.63 percentage points up to 43.7%. We can see here on the slide not just the numbers, not just the figures for the S&P 500 as a whole, but also in terms of sectors, the 10 sectors that actually that are actually part of the S&P 500. The most widely covered sector is technologies, and as you can see, the technology has more than 30 ratings per stock in that sector. Energy is next most covered sector with 28. Where is the energy? Here's the energy with more than 28 ratings per stock. Materials and utilities are the least covered stock with only around 19 ratings per stock on these sectors. Analysts are currently most bullish on healthcare. And as you can see, if we can find here healthcare, on the healthcare, 58.31% of all ratings are buy ratings. Energy, which had a great year this year, energy is the second most loved sector with 55.71% buy ratings, followed by technology in third place with 54.51% buy ratings. Pretty much all of the cyclical sectors have a higher percentage of buy ratings than the defensive sectors. The defensive sectors like the utilities and telecom. Although financial is notably weak cyclical sector with only 45.78%. This is for the financial sector buy ratings. Now, although energy has the second highest percentage of buy ratings, and let's take once again look on the energy line, the sector has also seen the biggest drop in buy ratings year to date. At the start of the year, 60% of all energy ratings were buys. So buys actually have dropped more than 4% right now to this year to be at 55, a little bit less than 56%. Okay. By the way, on contrary, technology and utilities have seen the biggest increase in buy ratings this year. This is something interesting. Moving on to individual S&P 500 stocks, here on the list presented, we have filtered the index to find stocks that are the most loved by analysts and also have high TradeNet stock scores. And actually, the TradeNet stock scores, it's a tool we are using, some kind of an algorithm that ranks for us stocks based on fundamental, based on sentiment, and based on technical measures. It actually giving us a combined rating. To make the list, a stock has to have at least 10 analysts covering the stock, so we know this is a popular stock in the analysts community. The 13 stocks here in front of you right now, in front of your screen right now, have at least 70% buy ratings and a TradeNet stock score. This is the right column. That is also more than 70%. It's more than 70%, which we consider a bullish bias. When we last ran this report, there were 18 stocks that made the cut. So the list has actually went down a little bit since January. RHI, Robert Half International, RHI, and Lam Research, LRCX, are the two stocks loved by analysts that have the highest TradeNet stock scores ratings, both of them higher than 85. There are some key healthcare names on the list, including Biogen, BIB, on the third rank, United Health, this is a UNH, and also CAH and Gilead, GILD. Just one consumer discretionary stock made the list with WYN, here it is, WYN, and while three tech stocks made the cut, LRCX, Akamai, aka M, and EMC. NDAQ and COF, here's NDAQ, this is the company that run the Nasdaq Stock Exchange, and COF, Capital One Financial, are the only two representatives of the financials on this list. For those of you interested in just analyst ratings and not TradeNet stock scores filter, without the filter we put on, here's a list of all S&P 500 stocks that have 80% plus buy ratings. And again, only stocks with 10 analyst ratings or more are included in this list. As shown, Delta Airlines, DAL, is the most loved stock in the S&P 500 with 100% buy ratings. 4 other stocks have 90% plus buy ratings from the analyst community, and these are AMT, PWR, SLB, and PCLN. By the way, PCLN price line is up the least year to date with a gain of 10.2%. The others are much higher, and for example, Delta Airlines are up almost 50% since the start of the year. Other notables on the list include Gilead. Again, here's Gilead, GILD. We have here also a CRM, which is Salesforce. We have also CMCSA, Comcast, the cable company in the United States, Facebook, and Google. If you are looking to follow the analysts, these are the names that you can get behind. Contrarians would suggest, however, that it can't get much better for stocks with such high buy ratings. So at 100% buy ratings, analyst sentiment towards Delta can only go down from here. The counter to the list of most loved stocks on the prior slide is this list, which contains the stocks that analysts have the highest percentage of sell ratings on. And as you can see, if we in the previous list had Delta Airlines with 100% buy ratings, or another 4 stocks with 90% plus buy ratings, here the highest score is Diamond Offshore Drilling with only 41 sell ratings, and that means that usually analysts are not fans of giving a sell recommendation. Usually they are looking for stocks to hand out a buying recommendation. Okay, so this list actually contains the stock that analysts have the highest percentage of sell ratings on. As shown, is the most hated stock in the S&P 500 with 41% sell ratings and just 3% buy ratings, with a 56% hold ratings on that stocks on that stock. After we have a Transocean, which is a rig, the same sector, and rig. It ranks second worst after with 35% sell ratings, followed by Clorox, CLX, Southern, SO, and Deere, DE. By the way, if you are looking for a counter trend play, I also put here TrendNet stock score to make a great filter, and you are going to, there are a few names here on the list that are unloved or hated by analysts in Wall Street, but they have bullish TradeNet stock scores, and 3 names are 3 names here on the list that have stock scores over 70 or higher are PFG, Joy with 70.4 and 71.7 respectively, all right, more than 70% each one of them. And we have also WY. You're going to find here WY, which has 20% of the ratings are sell ratings and only 53% buy ratings, but it has more than 74 points in our rank system. Okay, so this is something to, you know, maybe to pull out the chart and to examine the chart, and maybe to find to find an entry on these 3 stocks. Moving forward to Apple, and Apple is a great stock this year. It more than 25%, although this is the biggest stock in market value in Wall Street. So you would say maybe it will be hard for this kind of stock to move up, to push higher. But no, since the start of the year, this stock went up, crossed the $100 point, and actually is up more than 25% since the start of the year. Now, Apple is set to make a major announcement tomorrow, the 9th of September. The company is expected to release a piece of wearable technology that may or may not called the iWatch, and a new iPhone presumed to be called the iPhone 6. Apple is also expected to announce a switch from Gorilla Glass to Sapphire Glass as the surface material of choice for the iPhone 6, and we are going to understand later on why this issue is relevant for us. So I wanted to share with you 5 stocks that investors and traders might consider buying if Apple announces these products and changes, and let's examine them both on the fundamental side and also on the technical side on the chart. Let's start with GT Advanced Technologies, and here are all the symbols and the logo of the companies. GTAT is a company that manufactures and produces sapphire glass. This is a revolutionary material that is superior to Corning's. Corning's is an Irish company. The symbol of Corning's is GLW, and you can see all the charts that I'm going to show you, both on a daily chart on the left and a weekly chart. Let's put it here on a weekly chart on the right side, and on the weekly chart you can see a time frame of 2 years, so this is a long term. And as we can see, GLW, which is the producer of the glass for Apple devices so far, actually had a great bull run for the last 2 years as a supplier of one of the core material in the iPhone. But the sapphire glass is a material that is superior in durability and flexibility that Apple already uses as the surface material for the fingerprint sensor in the iPhone 5S. If Apple decides to cover the entire iPhone in sapphire glass, you will want to buy GTAT, because that means you are going to buy into a winner, and this is the chart of GTAT both on the daily and the weekly charts. Apple, by the way, has already pledged $578 million to GT Advanced for supplies of the material, but will it be for the iPhone or will it be for the iWatch? If Apple decides to use the sapphire glass for the iWatch, investors will likely sell off GTAT in a cascading manner, because sales of the iWatch will be unknown for an extended period of time. So it might be better off to wait a little bit on buying GTAT until the curtain is up and you actually know what is the iPhone 6 and how the glass is made for the iPhone. By the way, if it's going to be made from the material of the sapphire glass, I think it's going to be a screen that it's not getting any scratches, and this is a great improvement for the cover of the iPhone or for any smartphone in place. Next company that we want to examine is RF Micro Devices. Symbol is RFMD. And the iPhone 5S has a radio frequency module in it made by Triquint Semiconductor. Triquint Semiconductor, the symbol is TQNT, and as you are going to be witness right now, it has a tremendous bull run this year, a very nice uptrend. You can't find any better textbook uptrend than a TQNT, both on the daily chart and on the weekly chart. But by the way, on the weekly chart, it went up from $5 last May to more than $20 right now. So this is a tremendous uptrend. Now, RF micro, and let's put that on the chart. This is RFMD. All right, RFMD, another great chart to look on. And the RF micro and Triquint plan to merge by the end of this year in a tax-free reorganization. So regardless of whether Apple decides to use a new RF module by RF micro, or if it decides to keep the module by Triquint, TQNT, shareholders of RFMD are going to be winner of that. That doesn't mean you need to jump on RFMD. You can do it ahead of the announcement that is going to be by Apple. You can also try to pinpoint a better situation, a better, a better entry from a standpoint of a swing trader. Maybe after a reversal, after a pullback. Next company is Avago Technology. Symbol is AVGO, and Avago has one component in the iPhone 5s that improves battery life, and another component that helps manage clarity for voice-related activities. Since the beginning of 2014, since the start of the year, and let's bring AVGO on the chart. AVGO is up nearly 50%. Another runner in work. All right, Avago Technology, AVGO is up by nearly 50%, and Avago management plans to streamline its operations by selling its storage chip vertical to Seagate Technology. The symbol of Seagate is STX. Right now, if Apple continues to buy from Avago from AVGO, then AVGO shareholders would appear poised to win. This is already a winning stock, and let's see if it continues. All right. Next one is SWKS, Skyworks, Qualcomm. Sorry, Qualcomm. Qualcomm provides power management chips, LTE modems and GPS transceivers to Apple for using the iPhone 5s. Aside from Apple, you would be hard-pressed to find a smartphone on the market today that does not use a Qualcomm component, as well as patents. It has patents on all the devices and all the smartphones that are being sold today. As long as Apple's partnership with China Mobile, the symbol of China Mobile is CHL, continues to yield an expanding smartphone market in China, Qualcomm wins. Qualcomm wins when the overall smartphone market expands, largely because of their ever-growing place as a crucial provider to the entire smartphone market. So shares are also trading at a discount, and if you pull out the chart, you'll see that Qualcomm went down a little bit after it posted its last earnings. So right now we can have a Qualcomm for a discount after the latest quarter, and Qualcomm could be a long-term hold after the iPhone 6 release. Next on is another runner in Wall Street this year and also last year. This is Skyworks, SWKS, Skyworks Solution. And this is another Apple affiliate whose stocks keeps breaking out of all-time high ranges and continues to power higher. It would be easy to recommend, by the way, Nuance Communication, NUAN. This is the provider of voice and language solutions for Apple's Siri due to its bit down stock price, but that would be unfair. That would be for us as investors turning a blind eye to execution. Skyworks, on the other hand, not only has two components in every iPhone, but it also executes extremely well in terms of management. a stock chart with a nice uninterrupted wedge shape that seems to go up and up is a positive sign of consistent, strong management execution, and that is what Skyworks has. As a final thought, a way to profit from Apple might be simply to buy shares of Apple, and when iPhone sales outperform, Apple's shares outperform. Alright guys, this is the webinar, this is the things for today. Thank you very much for participating in this webinar. If you have any questions, you may post them right now in the chat. I will also scroll back to see if there are some unanswered questions. All right, so Cindy, Cindy is saying that all my iPhone screen break. Hopefully, with the iPhone 6, you are going to move on to a new era. Okay, guys, thank you very much for you. If you want this presentation, just type me, just send me an email, and I'll give you back the presentation. I'll send it for you back, and I'm giving Scott the microphone back. Cheers.
Okay, Shlomo, thank you so much. Yep, thank you, Shlomo, and another great webinar. Really enjoyed it, Shlomo. I really enjoyed this one. I'm looking forward to the iPhone 6 launch tomorrow or whatever it may be. I'm anticipating the iPhone 6, but you never know with Apple. Anyway, so I'm looking forward to that as a user and pick up the new one soon. So that was very good. And all the surrounding stocks that Shlomo has up there, the GTAT, RFMD, AVGO, Qualcomm, and then Skyworks, all those connected with that iPhone launch, we could see a pop. So we'll keep those possibly for our list in the morning to kind of go after. So that's really, really good information, and really appreciate it. So, okay, back to trading this afternoon. Yeah, that's going to be on YouTube, Manpreet. Yep. I'm holding absolutely nothing right now, which is a good thing, I think. Dow's down 20.